The first global empire of business wasn't powered by smart ideas, open markets, or fair competition. It was powered by exclusivity, force, and a legal right to dominate. Long before stock tickers, shareholder meetings, or corporate regulations, one company discovered a shortcut to wealth that had nothing to do with innovation. It learned how to fuse capital and coercion into a single system, and then sell pieces of that system to ordinary people. We're often told that capitalism evolved naturally, that trade expanded peacefully, that markets rewarded efficiency and creativity over time. But that version of history is tidy and deeply misleading, because the financial world we recognize today was not born from freedom or choice. It was engineered through control, protection, and organized violence. To understand how modern corporations gain their power, you don't start in a boardroom or a stock exchange. You start with spices, ships, and a monopoly that rewrote the rules of profit forever. To understand how modern capitalism truly took shape, you have to start with something deceptively ordinary. Something small, something dry, something most people barely notice. Spices. In the late 16th and early 17th centuries, spices were not culinary accessories. They were strategic assets. In a world without refrigeration, they preserved food. In a world without modern medicine, they treated illness. And in a rigid social order, they signaled wealth, power, and status. Nutmeg, cloves, mace, and cinnamon were worth staggering sums in Europe, sometimes more than gold, by weight. The reason was simple and brutal: scarcity. Nearly all of the world's valuable spices came from a handful of islands in Southeast Asia. Control those islands, and you controlled supply. Controlled supply, and you controlled price. This wasn't economics as theory. It was economics as geography. At first, European traders fought over access. Portuguese fleets clashed with Dutch fleets. Merchants raced each other to ports. Cargoes flooded markets one year, vanished the next. Some voyages returned immense profits. Others ended in shipwreck, disease, or financial ruin. This chaos created a problem no one likes to talk about. Competition was destroying profits. When too many traders succeeded, prices collapsed. When prices collapsed, investors lost everything. For the people funding these expeditions, free competition wasn't freedom, it was instability. Merchants could survive risk, investors could not. They wanted predictability, they wanted protection, they wanted certainty in a world defined by distance and danger. And that pressure produced a radical idea. If competition was the problem, eliminate it. If markets were unpredictable, control them. If violence was inevitable, organize it. What followed wasn't a natural evolution of trade, it was a deliberate redesign of it. A system built not to serve markets, but to dominate them. That redesign would permanently fuse commerce with state power and change the meaning of capitalism forever. In 1602, the Dutch government made a decision that would reshape global finance. Instead of allowing rival trading companies to compete, it merged them into one entity, the Dutch East India Company, the VOC. On the surface, it looked like a financial breakthrough. The company sold shares to the public. Risk was spread across thousands of investors. Ownership could be traded without ever boarding a ship. Ordinary citizens could profit from overseas trade without leaving home. But the real innovation wasn't financial, it was political. The VOC was granted exclusive rights to trade across vast regions of Asia. No Dutch merchant could legally compete with it. No rival company could enter its domain. And unlike modern corporations, the VOC wasn't just allowed to trade, it was allowed to rule. The company could raise armies, build forts, sign treaties, imprison enemies, execute smugglers. It operated not under the state, but as an extension of it. This monopoly transformed profit mechanics overnight. Instead of responding to markets, the VOC dictated them. Supply was restricted, output was controlled. Prices were kept artificially high. Anyone who disrupted this balance wasn't a competitor. They were a threat. Nowhere was this clearer than on the Banda Islands, the world's only source of nutmeg at the time. Local populations were forced to sell exclusively to the VOC at prices the company set. When resistance emerged, it wasn't negotiated away, it was crushed. Villages were destroyed. Communities were wiped out. Survivors were enslaved or replaced with forced labor. Nutmeg trees were deliberately burned, not because they lacked value, but because abundance threatened profits. Scarcity wasn't an accident, it was policy. The violence stayed far from Europe. But the rewards flowed directly back. And for investors, the system worked exactly as designed. Back in Amsterdam, the VOC looked nothing like an empire of force. It looked orderly, professional, financial. Shareholders saw dividends, they saw ledgers. They saw rising valuations. What they didn't see were massacres, forced labor, or destroyed communities. They didn't need to. The separation between profit and consequence was the VOC's most powerful invention. For the first time in history, large numbers of people could benefit from imperial violence without participating in it, witnessing it, or even acknowledging it. Risk became abstract. Responsibility was diluted. Ownership was reduced to paper. By the time money reached Europe, the blood had already been erased from the equation. This changed the logic of capitalism itself. Before the VOC, trade was personal. Merchants faced danger directly. Losses were immediate. Gains were earned through exposure. The VOC created distance, geographic, moral, and psychological. Investors didn't need to understand Southeast Asia. They didn't need to know the Banda Islands. They didn't even need to know what nutmeg looked like growing on a tree. They only needed to know the return. That model proved irresistible. Other European powers copied it. Chartered companies spread across the globe, each backed by the state, each protected from competition, blurring the line between commerce and sovereignty. Even when the VOC collapsed in the late 18th century, its structure survived. Modern finance still relies on the same principles. Distance between decision and consequence. Concentration of power disguised as efficiency. Profits privatized while costs are distributed. The tools have changed. The language is cleaner. The violence is less visible. But the incentives remain strikingly familiar. As this story comes to an end, the takeaway isn't that markets are evil or that capitalism somehow failed. It's something more specific and far more useful. Capitalism was designed. Its outcomes aren't random. They follow incentives built into the system from the very beginning. History doesn't echo because it's trapped in a loop. It echoes because the structures remain familiar, and every generation assumes this time is different. Understanding that difference is the first step toward seeing power clearly. If this changed the way you think about money, history, or markets, consider subscribing. Because the past isn't just something we study, something we're still living inside.